My name is Joseph Smith. I am the president of Travel Talks, and I'd like to welcome you to the recording of the TNAA Total Med Tax Masterclass that was presented on February 18th, just last week. And this is for those of you that were having difficulty with the audio, as well as those that were not able to attend. And as we go through this, we don't have the benefit of the chat function for anybody to ask questions as we go. So we invite you to send those questions. You can directly to me at info at traveltax.com. So let's dive into this. It will take approximately 40 minutes, maybe a little earlier as we go through this. And just a plug, this is presented by Travel Nurse Across America and Total Med, two agencies that have been into business for quite a while that have combined forces. And there is a referral sign-on bonus that is shown on this screen, but please reach out to them because this isn't a live presentation, so have the benefit of that link. You may be able to find it or have found it already. But the referral bonus is there, and they would love for you to reach out to them for your next assignment, or even if you just have a few questions. And they're the ones bringing this to you, and you can thank them for that as well. So, give you a little bit background about who I am. Way back in 1984, and some of you were not born then, I know that. I was finishing up the respiratory therapy program in my hometown. And then when I finished my respiratory therapy classes and started practicing, I went across town and started working on my bachelor's in accounting. And when I finished, I decided to hit the road as a travel respiratory therapist, and I did so for about 3.5 years. And along the way, I started accumulating some tax clients. This was my license plate that you see on the screen that I had. And I had a old Jeep, a Nissan Stanza, what they called a Wally wagon as well. And I had a lot of stuff stuffed inside it. And this was the license plate I had. And I actually had a couple of conversations at street corners while at stoplights, asking me about what I was up to. So it was a great novelty to have that license plate. But I traveled, like I said, for 3.5 years, and I started doing tax work for my coworkers. And this is back before the software became robust in tax prep. It was mostly by hand. And I started doing the multi-state tax returns that all of us have to file. And from there, about a decade later, I took my tax practice national, what's known as Travel Tax and Travel Tax Canada. And I don't want to bore you with more details than necessary, but later on, I obtained my master's in taxation. But I also do quite a lot of work with the agencies in the area of tax compliance, primarily with the per diems and stipends. I have written Supreme Court briefs, Ninth Circuit briefs, testified before the New York Supreme Court in staffing related tax cases. If you have ever had the privilege of reading the late Kay Slane, or Epstein LaRue is her pen name, her book called Highway Hypodermics, I was one of the co-authors with her, and I wrote her tax chapter. And one of my greatest pleasures was to have been part of the founding group of the Travelers Conference that comes out every September in Las Vegas, something we really encourage you to go to. And you can find the website at travcon, TRAVCON.org. And the next 2026 convention will be held again in Las Vegas at the Paris in the middle of September. I do a lot of public speaking on tax compliance issues in the industry, and we also do quite a lot of audit representation. Uh, so feel free to ask the questions, even the hard questions that may come. What you're going to learn in this presentation, I've got broken it down into four different areas. The big one, the one that most people have questions about, is your home tax residence. Then we'll dive into what you have to do for your multi-state tax filings, and then talk about what are per diems. A lot of people are really confused on how those work. And then finally, at the end, I'm going to go over some of the new tax laws that a lot of travelers are able to take advantage of, starting this year, or actually the last year, the one we're filing for right now this year, the 2025 tax year. And there's another one coming on board for this year that we'll be filing for in 2027 that you can take advantage of as well. So let's dive into the hardest part first, the whole concept of a tax residence. Now, to understand it, we need to look at a very fundamental concept of how your compensation works, and that is the concept of a reimbursement. Reimbursements and the concept of that is very important when we're talking about per diems and stipends, etc. So to give you a very simple example, let's say you have a roommate and you don't really want to go out, but you need some groceries and your roommate's headed off to the grocery store. And you tell them, say, hey, can you pick me up my favorite beverage or some condiment or whatever it might be? And of course, they're not going to say no to you. But when they come back and bring those items to you, guess what they're going to expect from you? Pay them back, right? They're not doing this for free. So they expect you to reimburse them for the expenses that they incurred on your behalf. Make them whole. So whenever an employer, the staffing agency, or even the hospital facility, pays you for your license, for your CEUs, even if they pay that directly to the vendor, it's a form of reimbursement to you because it's an expense that you bore on their behalf in order to perform your duties. And likewise, whenever a agency pays you a stipend or per diem for lodging, meals, even if they pay it directly to the apartment complex, which you don't see that much of, like you did when I was a traveler back in the 90s, that is a form of reimbursement, even though it comes as a per diem. So you are being given money to help offset expenses that you incur because of the job that you were doing or the nature of the job, which in our world, we're traveling and we have travel expenses. So whether it's lodging, meals, travel pay for mileage and transportation, or it may be a license, CEU, uniforms, or what have you. All of these are a form of reimbursements. Now, specifically, when we start talking about travel reimbursements, we are focusing on the tax residence issue. And one more thing before we go to that. Reimbursements, the stipends and per diems, etc., they are not income. They're not taxable earned income. They are not part of your wages because they are expense offsets. And that's really important to understand when you're applying for a loan or having to represent the amount of wages that you earn, even if you have, say, a government health plan. The focus is on the taxable part, not the reimbursements. So this helps us dive into the tax home scenarios and the rules that regard that. Because unless you have a valid tax residence, those stipends and per diems cannot be paid to you on a tax-free basis. And that's why a tax home is so important, because it determines whether those reimbursements are tax-free. And it is a very confusing topic, and it is highly litigated in the history of tax court cases and even outside of tax court. Because a lot of people misunderstand it. And one of the reasons, probably the most important reason people misunderstand it, is because they confuse a tax residence, a tax home, with a permanent residence or a permanent home. And these are entirely different concepts, even though they may often wind up being the same place after you have determined where they are. A permanent residence is your legal residence. If I look at your driver's license, your car registration, your voter registration, I'm going to find where your legal residence is. A tax residence is not determined by that, though it can be killed by that, which we will find out in a little bit. But a tax residence is determined on its own. And when you try to figure out where your tax residence is, it's like an ACLS algorithm. I mostly was intensive care when I was a respiratory therapist. And my ex-wife was an ICU nurse. And we used to run codes together. And we had to learn this. We had to every year, PALS, ACLS, the neonatal version, as well as our basic CPR, BLS. But there's a decision tree in there, and these decision trees are very much how you attack the determination of a tax home. So starting at the top, the definition of a tax home, before you go into any exceptions, the exceptions are important to us. A tax residence is one's main place of income. Where is it that they physically earn the majority of their income? Now, before you jump to conclusions, we're going to get to where we are as travelers, but we have to start at the top of the food chain, top of the decision tree. So the tax code definition, a tax home is one's main place of income. What does that mean by income? Income means where do you earn the money? Where do you conduct your business? Place is the geographical commutable area in which you earn your income. If you work at two hospitals 5 miles apart, your tax home covers both of those because you can commute to both. So we always start, can we identify regular income coming from one area? If we can, we are finished. We have our tax residence. So starting at that, this is where the exception comes in for most of us. As travelers, we mostly do not have a regular place of income because we do 3-month assignments in one city, we go on to the next city, we go on to the third city, fourth city, so forth and so on. We generally don't repeat these cities. Whether it's a 3-month assignment, 6-month assignment, 9-month assignment, we go on to another place. Or we should, which we will find out shortly. We don't have regular income locations. It's hard to pin us down there. It's hard to anchor us to any one general area. So when you are faced with this kind of situation, because a tax home is your regular place of work, but if we can't find that regular place of work, we can then go to the exception to the rule. And the exception is what 95% or how 95% of travelers actually qualify for a tax residence. And the exception goes like this. Okay, you don't have a regular place of work, but are you in a situation where you still maintain your physical dwelling, whether that be in the form of mortgage, rent, or shared expenses? You maintain that physical dwelling and you are forced to duplicate those expenses because you are away from home on an assignment. Not duplication in amount, but duplication in the fact that you have to maintain 2 homes. You have your main home, and then you have your travel home. And this duplication is determined on a daily basis, not a general basis. So your per diems and stipends, they're paid to you on a daily basis. Even if they're paid to you by an hour, they are paid to you on a daily basis. You just run the math backward and you get to a 7-day per diem. Even if they try to play a gimmick where they say they're paying it to you by the day, but actually giving you more than what's allowed, like a multiple, like if you work 3 days a week and they pay it to you 2.3 times the daily rate, it's still a 7-day per diem. So the per diem has to match up with the expense, which we will also see shortly as well. Now, if we qualify for a tax residence based on the duplicated expense exception to the rule, this is where our permanent residence comes into the back door. If we say we're keeping a home and our legal ties aren't consistent with that, then we may jeopardize our tax residence status. And the four big drivers of this is your driver's license, your voter registration, your professional practice license. Where is the main one? If you have a compact license, what is the anchor for that? Where is it based in order for you to benefit from the compact license elsewhere? Then the other one is car registration. So the most important ones generally start with the driver's license, then voter registration, and then your practice license. Car registrations are sometimes those get fouled up. They don't kill it, but they're good to be in the same location. They're part of the evidence, not the only piece of evidence. This is why you want to be consistent. When you say you have a tax home, say in Duluth, Minnesota, your driver's license, your car registration, voter registration, all of that, and your Minnesota practice license should agree with this. You don't want them scattered around all over the place. Now, let's say you have established that you have a tax residence. That's good, but how do we sustain it going forward? Let's say our travel career stretches out to 3 years, which is typically how long a traveler lasts. They usually travel for 3 years and they stop, take a permanent job, or maybe take a break before doing it again. I find it interesting, having done taxes for travelers for almost 30 years, that, and it's a piece of trivia more than anything else, most of my travelers who are ladies will stop at the 5-year age mark. The guys at the 10-year mark. It's a certain psychology to it, but 5 years and 10 years. But regardless, most travelers stop after about 3 years. So here's some limiting factors that we have to consider when our tax home long term. Number one, let's say I have a house and I pay a mortgage on it. Well, I need to be living in it. So if I start renting it out, I need to make sure that that renting is proportional, or it's a vacation rental, such that I am not displaced from that home more than 12 months each year. I have to maintain a portion of it. I can rent it out so long as I don't rent it out all the time, or I rent it out only, say, one bedroom when I have 2 or 3 bedrooms. But you cannot completely displace yourself. Otherwise, you really don't have a home. It's not duplication when your home now becomes a business property that is separate from your personal life. Storage units, I'm sorry, even if they're in gated communities, they don't qualify as a home. Now, we all know there are people that live in storage units, and I know you don't. The hobo Hilton, as I would call it. But it doesn't make a tax residence, doesn't make a dwelling that you actually maintain as your permanent residence. And then an RV that goes with you on an assignment. These are great ways to have second residence. So after a while, all the cost is eaten up and your per diems cover way more than the cost of it, which, by the way, you get to keep, which we'll see later. But if the RV is your only home, you're not duplicating. So the only way you can maintain a tax home and be an RV traveler is if you maintain that permanent residence, dwelling, not just a driver's license and a post office box, dwelling, or you have a job at home that you return to on a regular basis, or you have a regular job someplace else that you every year you go back to in the same area. But an RV is a great second home, but if it's your only home, it's going with you. You are never away from home, and an empty pad or parcel does not count as a residence. Other limiting factors, and this is the ones that you probably have heard more of. Because you are supposed to be in a situation where you have no regular place of income, everything needs to be temporary. And to prevent temporary assignments from becoming indefinite assignments, because it doesn't matter whether you take short breaks or not, continuous employment skips weeks at times. And if your continuous employment continues, it cannot be continuous in the same area more than 12 months. It's called the 1-year rule. Whether you go home 2 weeks or 3 weeks does not change the fact that it's continuous employment. And here is a word of warning. Our industry, healthcare staffing, has a history of non-compliance. And you have a lot of staffing agencies out there that will tell you all you have to do is go home for 30 days and you can restart the 12-month clock. And that is dangerous. There's no way that gets done. But then, Joe, how long do I have to go away before I can come back? Generally, you need to be gone just as long as you were there. You have got to have a situation where you have not created a regular place of work. Because with the 1-year rule, there's a 3-year rule as well. And the 3-year rule says you can't go back to the same place 3 years in a row, even if it's one assignment, because now you establish a pattern. So what we tell our clients to bridge those two rules is don't be in the same place more than 12 out of 24 months. I don't care what the agency tells you. One of the beauties of being able to partner with TNAA and Total Med is TNAA and them have had a history of compliance. I have worked with them and their policies, and I have worked with their travelers for many years, and it is always a pleasure when you can deal with an agency that has a history of compliance. Now, in healthcare staffing, even if the agency is stellarly compliant, you have a lot of recruiters that jump ship. And if any of you are aware that Omaha has like 38, probably 35, over 30 staffing agencies right now, you will see recruiters jump from ship to ship, and they are bringing their training from other sources. They sometimes will bring their bad policies with good agencies. So be careful with this. 30 days going home, and this is what a lot of agencies are pushing, does not reset the 12-month clock. You need to be home 30 days a year. That's a different thing. But that 30 days, if you have been there 12 months, will not allow you to come back for 12. So follow the 12-24 rule. And what is the agency's break-in service? They may not have a 12-24 rule. They may say you got to go home for 3 months, which is okay because the agency is not in the business of policing you. And that compliance is okay for them as long as they are doing that due diligence. But you, the traveler, are ultimately responsible for your tax obligations. So even if they say you can go home 3 months, you need to check with a tax advisor, whether it's us or somebody else. Let somebody watch your back, make sure that you are staying compliant. Other limiting factors that we have is the old 50-mile rule. It is a myth. It does not qualify you for stipends. It is a fantastic disqualifier. And let's not confuse this with facility rules that may require you to be more, maybe even than 75 miles away for you and to be able to receive premium pay. That is a policy path. That is not a tax rule. So facility rules may supersede an agency's compliance level when it comes to getting that premium pay. A 50-mile rule only means that you drove 50 miles. It does not ultimately pass the test. The test is, if I'm going to give you a lodging allowance, you need to have a lodging expense that this can anchor to. The proof is the expense, not the mileage, not the time. If you choose to commute 75 miles each way every day and sleep in your own bed, your lodging allowances are taxable because you didn't have an expense to anchor to it. And I will guarantee you that many people, even after just listening to what I say, will ask me the question, how far do you have to be away in order to get tax-free stipends? I just answered it. And I'll say it in another way. Far enough away, there's your answer, far enough away that it requires you to get rest or sleep at the assignment location and incur the lodging expenses to make that happen. Duplicated expenses. You are being reimbursed for your lodging expenses, not when it's a lodging allowance, not because you drove 51 miles. And if you go back to my beginning of my blog almost 11 years ago, this is what I put up there. Whack-a-mole. Now, you'll see a picture of my sons. My sons were adopted from Lithuania when they were 9 and 10. And after their English sort of stabilized, my oldest son saw me sitting in front of the computer all the time. He thought all I did was play video games. And he came up to me and said, "Dad, what do you do for a living?" Still with his broken English. I took them to Dave and Buster's. And I said, "Boys, this is what your dad does for a living. 50 miles. 50 miles. I played whack-a-mole." And I said, "This is not really what I do for a living, but this is how I feel I'm doing for a living." This has been coming up for the 30 years that I have been doing tax work in this industry. 50-mile rules can disqualify. They should not be the qualifier. That is the first leg of our relay here. And that is where most of the information can be confusing. So feel free to put some questions in email to info@traveltax.com, or even give our office a call if you have further questions on that. And while I'm at it, if you go to our website, www.traveltax.com, we have some very targeted consults that will address your tax home or a big question that you may have for some sort of event coming up that may trigger additional taxes like inheritances or selling or buying investments. But one of my staff will deep dive into your situation and go over your tax resonance in order for you to feel confident going forward. Because remember, the agencies aren't going to vouch for you in an audit. You are responsible for that. So you always want to be on the straight and narrow and be compliant. So feel free to take advantage of that. Now we're shifting gears to multiple state tax. So basically the question is, what in the world do I do when I work in all of these states? How do I file my taxes? There's two general principles that we have here. Number one, your home state taxes all of your income. In tax lingo, we call this global income or everywhere income. They tax all of it, regardless of whether you work at home or work away, work in another state, or even another country for that matter. Your home state taxes all of it. But also, the work state taxes what you make there. Now, you're not double taxed. And the agency's responsibility is not to your home state. It is to your work state. Their first and foremost obligation is to your work state. Now, there's some exceptions that I'll cover in a minute. The only time that the home state, the agency is obligated, is to Michigan, but they have to have nexus or presence in Michigan for that to happen. Michigan has a rule that if a Michigan employer sends you to another state, you got to withhold for both. But that rarely happens. So you're not double taxed. That's usually the question that follows. I got to report it to both. It's being showing up on my W-2 for both. No, your work home state is going to give you a credit for what you pay to the work state. So ultimately, you wind up paying the higher of the two state rates, even though you may have to separate that and allocate it between the two. So herein, with everything, there are exceptions. And the biggest exception to this arrangement is when the work state and your home state have what is known as a reciprocity agreement. A compact license is a reciprocity license. So in tax, if you work in a state that has a reciprocity agreement with your home state, you only pay to your home state. So you have reciprocity agreements are usually common with a lot of border states, especially up there in the what I call the mid-Atlantic, the Rust Belt states like Pennsylvania, Ohio, Kentucky. There are some arrangements where they are not bordering, but they share a body of water, which is sort of interesting. They're orphaned from each other, like Kentucky and Michigan. So you have reciprocity states, and then you have this really oddball 5-state agreement between California, Arizona, Oregon, Virginia, and Indiana, where everything I just told you goes in reverse. It's the work state that credits you for what you pay to the home state. So there are some exceptions out there, but generally the general principle is home state taxes at work state taxes at within home state says, all right, we'll give you the credit for what you paid to the work state. Now, that brings up some other scenarios. One of those is, what if my home state has a higher tax than the work state? You have to make up the difference. And sometimes that's a lot, especially in cases where you come from a high tax state like Oregon and you work in Washington that has no tax. My oldest son does this. He lives in Portland and he often used to go up into Washington and Vancouver, Washington and work. He had to pay the Oregon taxes on the Washington income because Oregon was his home state. But let's do that in reverse. Washington has no tax. I go work in Oregon. Well, I'm sorry. I have to pay Oregon taxes on Oregon income. So the states that have no tax, don't think of them as exemption states. Think of them as taxes of 0%. And what is your agency supposed to do? And I mentioned this already. The agency is required, first and foremost, to accommodate your work state. Where is it that you're earning the income? Now, I need to say two things on here. One is sometimes, from a tax perspective, I like this for my clients. Agencies will report and withhold for both the home and work state. And this is fantastic for those of you coming from high tax states to make up that gap. But a lot of people panic when they see the W-2s or the pay stubs with two states being withheld. That's not a double tax. That's just a reporting and withholding doubling or duplication. You will eventually get the excess back when you file your returns. So that is actually a good thing. The only time it becomes a problem is for you that are Illinois residents. And you may see an agency modify that reporting, but that's something else on the side. Also, one thing I want to emphasize, this is a license issue. If you have a compact license, you are expected to file a resident return in your home state where that compact license is located. If you don't, you can jeopardize your license. Now, when you're working in the compact state and you have authorization to work in that other state and you have income, you definitely want to file that return, because most professional practice boards, whether it's healthcare, engineering, other professions, they cross-reference the existence of those licenses to filed tax returns. It started almost 20 years ago with California doing this, but now it's rampant because it's all done by computer. So be sure to protect your license and file definitely where you work and along the way, all of the places that you work. Now, in a lot of ways, this is just a rehash on this slide. You're going to file in every state you work. You're going to file as a non-resident let me back up. You're going to file in your home state, and then you're going to file as a non-resident in your work state. And again, it's a license issue as well, but here's a word of warning. In the tax prep universe, you have your chains, and then you have your local firms and your local CPAs. Most CPAs do not do taxes. They do public accounting. They usually give their taxes to somebody else in-house or to a tax specialist. I have CPAs coming to me all the time with wanting advice, and I charge them a consulting fee. So when you're dealing with most tax shops, they generally do not do multiple state taxes on a regular basis. They know their state and usually some border states. And when you go to chains, if you are a new client in that office, you will generally get a new preparer. And they are going to follow their rule book. And if you're there in that state for longer than 90 days or whatever on the books constitutes residency before considering whether you are really intending to move, they might file you as a part-year resident everywhere you go. And that's something you don't want. So it's something to be careful about. There's a lot of fantastic preparers out there. I am not saying we're the only ones. I would like to say that, but I'm realistic. No, there's some good ones out there. But that is one of the biggest mistakes that I see along the way when I'm looking at new clients that come to us and we review their previous tax returns. Some of you are coming from Canada. Now, I can do a whole seminar on this. In fact, I do a seminar in Toronto for one cross-border tax staffing agency, and we go all over the intricacies of this. And there's information on my blog concerning this. But in a big picture, if you're working from Canada, the tax home rules still apply. You're filing, you still are going to file as a resident of Canada. You're going to file as a non-resident in the U.S. Even if you're over 183 days, the treaty jumps in and changes the substantial presence test there. Canada Revenue will give you credit for what you pay to the IRS, to the state, Social Security, and Medicare. And whatever is left over trickles down to the province. Same thing applies to Quebec as well. I only want to say one or two things for moving on, because this is for a smaller subset of you. Don't fall into the trap of letting two people handle your returns unless they're talking to each other. Some of the biggest mistakes I see coming from cross-border clients that come to us is that they had one person in Canada doing that and one person in the U.S. and they were not talking. The U.S. person inadvertently filed them as a resident, didn't ask about foreign income, and vice versa. Got to be careful of that. And when you talk to financial advisors and investment advisors, you need to make dead certain they understand, hey, I am a cross-border professional. Because all they're going to do is apply their domestic rules to you. And for instance, a Roth IRA should not be on your table if you're Canadian. CRA will tax that. So If you have questions about that, feel free to give us a call. We have an entire consult for our cross borders. Now we're at the third leg of our relay. These are the two smaller ones. This one, what is per diems? We go back to what we were talking about with reimbursements. Per diems are part of a reimbursement. Stipends, allowance, subsidies, company provided housing, etc. Remember, these aren't wages. And just because the agency gives it to you tax-free doesn't necessarily mean you do have it tax-free. So when we are dealing with this, a lot of times we're going to go to the GSA site, the Government Services Administration, and they have these per diems up here. Don't know if you can see my arrow, my mouse arrow, but you have a lodging rate and then you have a meal rate. So what are these things? What do we do with these? Well, if you can imagine going back to the 1940s and 50s, and we have people traveling, let's say we're all just a bunch of salespeople, and our company sends us out to visit clients, take orders, and we have to travel. So all of us leave on Monday. We are accumulating paper receipts. And we're going to bring all that stuff back home, and we're going to put it on the desk of some really tired payroll person, and we want our money back because we had to spend it ourselves. We didn't have a company card or anything. Well, the federal government has a lot of people traveling for them, so per diems, it is a simplification process. Instead of dealing with receipts for lodging and meals, what it is a standardization based on cost of living index of the amount that can be paid for a reimbursement stipend per diem for lodging and meals that can be used as a receipt substitute. That's exactly what they are. It eliminates the need for you to give the agency receipts. Now, word of warning, don't throw them away because the agency can audit you anytime they want to because they have compliance regulations and obligations to the IRS. And the IRS and even a state revenue agency can audit you for whether or not your per diems were used or you had a lodging expense. The agency has an obligation to ensure that your tax residence is valid before they give you the tax-free allowances. But overall, per diems are receipt substitutes. And what that also means is if your per diem is similar to this $110 a day for all of Nebraska or $122 for Omaha, and you only spent $80, you get to keep the difference completely tax-free because we're using the per diem tables as the expense receipt substitute. So this means, how do I make money in the industry? Is I live cheap. I don't recommend eating a lot of ramen noodles. If you look at the fat content on these things, it is incredible. When I had my first heart attack in 2023, I had to sort of do a remake of my diet. And I had a bunch of ramen noodles. I threw them all out. And I try to get noodles that don't have a high fat content, but they're cheap and they're good. I love them. But back to the per diems. Eat cheap, but eat healthy. These are my boys when they were younger. On their birthday, I would give them Mountain Dew and donuts. And I would actually send them to school with a apology note to the teacher saying it's their birthday. I juiced them up with Mountain Dew, caffeine, and lots of sugar. So my apologies for them not paying attention. And usually I drop my kids off and I would go run, find their teacher and give them the note by hand. But eat cheap, but eat healthy. My efforts at celebrating their birthday did not stunt their growth. This is them just a few months ago. My oldest is 24, who, by the way, has a used car dealership in Portland, Oregon. So if you're traveling there and you need a used car, let me know. We'll take care of you. And my youngest lived with me up until a few months ago. He obviously is a bodybuilder and all the rest. Now, per diems present another quandary that we run into in this industry. Most of you notice, and you are aware, that your taxable wages are generally lower than what you would get as a permanent staff. That's because the bill rate that you're being paid is not that much higher than permanent staff when you include all of the benefits. And when you have an agency working to secure that position, they take that bill rate and then they have to break it down between three components, basically three: your taxable wage, your reimbursements, and what they take. Traditionally, and supported by statistics, the agency admin fee, as I call it, is 20 to 25%. The median is 23.2, 23.3. Even during COVID, the average agency cut was 23%. That has been historical average. Sometimes they do take more, but on the average, they're only taking 23%. What is left over comes down to your taxable wages and your reimbursements. So a lot of times there is a tug of war here. If you want a higher taxable, it's going to have to be pulled out of your reimbursements or out of the agency cut. If you want more in reimbursements, it's got to come from someplace else. There is no government subsidy infusing into this equation. It is a tight pie. You take from one, you got to take from the other. So this can pose a problem, especially if agencies that like to drive the taxable wage very low, because payroll taxes are only on taxable income. So beware of some extremely low rates that you might encounter out there. And there are some things you want to avoid with that. And feel free to reach out to us if needed. When is a per diem taxable? Well, obviously, if you don't have a valid tax residence, then you need to add your per diems to your taxable income when you do your return. And we do that often. Sometimes it's just the agency being belligerent and not doing it, even though the traveler has said, hey, I don't have a valid tax home. Otherwise, it's just a mistake that was made. The other times that you would add it back, let's say you go to the assignment location, stay in a hotel for 3 nights, and you're home at 4 on 4 of those nights. You don't have 7 days a week of expenses, and your per diem's being paid to you on a 7-day basis. So you now have taxable per diems, maybe 4/7 of that. It all depends on the number of days that you actually incurred the expense, because that per diem has to have an anchor, that being your lodging expenses. And now for our finale is the new tax laws. And travelers can have a trifecta here. The biggest one is the overtime. Now, let me be very clear, because there's a lot of misinformation about this. Overtime is deductible, but only the premium. You have your regular rate, and then you have that time and a half. It's this that is deductible. And it's only that 50% premium. If you get paid double time for overtime, you only get half of that extra amount as your deduction. So in 2025 tax year, that's what we're filing for right now in 2026. The IRS said, look, we're not going to require you to do absolute reporting until the next year. Use your pay stubs. And I tell you, the stuff that's on the W-2s are all over the place with some agencies and other employers. It's not the agencies, it's everybody. So we have to look at pay stubs often. And the California rules for overtime after 8, that 8 to 12, unless you are beyond 40 hours in the week, that doesn't apply. It has to only be that which is set and mandated by the Fair Labor Standards Act. And that's 50% more of the regular rate after 40. That part is deductible. The other one that I don't have on the slide is tips. I have a number of traveler clients that do work as wait staff on weekends. And if you're fast on your feet, like a nurse or a therapist, and can run through an order and everything, you can make some good tips. So I have travelers that are working on the side as bartenders and wait staff. No tax on tips. Car loan interest. You buy a new car, guess what? You get to deduct the car loan interest there. And then one thing, the other thing I would talk about is 529 plans. Those are those educational savings plans run by states. They can be used for college tuition in K through 12 private school. And with the new tax laws passed in July, you can now use those for certifications that are not necessarily college tuition, and you can use them for homeschooling. Almost anything related to education. And then one thing that's not up there, because it applies to this year, 2026, is you don't have to itemize to deduct your cash charity. As a single, if you give up to $1,000 in cash equivalent, credit card, whatever, to a charity, you get to deduct $1,000 without having to itemize. If you're married and you're filing jointly, it's $2,000. So you can have a trifecta here of car loan interest, 529 plans, and overtime deductions. And this is why we run into some myths every now and then where people say, well, I don't want to work more because I'm in a higher tax bracket. Well, now overtime is deductible. How about that? Finally, if you need any more information, here are our QR codes. If you can't take a snapshot of this, just go to info@traveltax.com or even call us at 4. We have not only a series of consults that are tailor-made, we have our big social media platforms there in TikTok, Instagram, Facebook, and LinkedIn. And then we have what's called the Travel Tax University. For anybody who is our client, we allow them to go into our educational database that we have accumulated over the years. And if you do anything, at least subscribe to our blog. New things come up there all the time, and I keep you abreast of all the tax situations that are going on in the industry. Thank you for enduring this 52-minute presentation. It's a lot of information. I know that. So follow up with it, visiting our website, the blog. Do take some time to reach out to TNAA and Total Med. Thank them for having this, but also look into having them do or provide your next contract. For now, safe travels. We'll talk later. We have a blog and a education university on our website. Feel free to bring your questions that you didn't get answered here to the email address in the middle of the screen. Our blog is updated very frequently, and it's free for anybody who wants to view it, and you can subscribe to it. And I get a lot of updates to current tax laws. And one big one right now is the overtime is a federal tax rule, and not every state is following it. And that happens with any new tax laws. States have to approve it. But what is interesting is those new tax laws were passed in July, and there are a handful of states that may decide later in the year to retroactively allow it, which is going to cause a lot of amended returns potentially. So it's a very dynamic application that's going on. And if you follow our blog, we'll keep you up to date on that. So Isabel, I can scroll up on here and find some questions.
Let me go into the questions because we got a lot, and I'm going to start with Alex White. He was asking what is in considered area. I think it was in the beginning. Alex, you might have to put in the chat again what you exactly want to know, like what is in considered area. Or Joseph, does that already help you answering this question?
Uh, I scrolled up to the very first one that I remember coming through, and you want me to just read them? I'll just read them out and answer them. Is that okay? Uh,
Yes, because Alex White just had a question. He was
oh,
asking what is considered an area. It was when you were talking about in the beginning about the areas. It,
well,
it was
when you're
it was
talking about
it
that,
was related to staying in an area for too long, basically. So he's
okay,
asking what a considered area is.
yeah, an area is there's two ways to look at it. An area is a commutable area. So your tax home is your commutable area in which you normally would be working. Now, when it applies to staying too long in a temporary job area, one rule that I use is let's say you go to city A and you go to city B for the next assignment. If you can live in the middle of those two and have a reasonable commute to both, it's still the same area. And we have a term in our office called the orbit nurse. Uh, and this is very common for going to Oakland, San Francisco, San Jose, and repeating the process. All you're doing is orbiting. You're not really breaking orbit and traveling, you're just hanging around the same area. And that's something you want to watch out for as well. Because if you can live there and commute to two or three different places from a central point, it's still the same area.
Okay,
Uh,
Ashley. Oh, were you
Go
adding
ahead.
something more? Yeah, because we have more questions. Ashley wants to know if your home state is higher than your work state. You're saying your agency doesn't have to file the additional home state tax that is missing. For example, Iowa is like 7%, working in Nebraska, it's 5%. So who is required to get that additional 2% back to Iowa?
You're required to pay it if Iowa is your home state.
Okay.
Uh, and courtesy withholding is probably common with about 40% of the agencies. It has become more problematic in the last few years for various labor issues and all. So it's great. Uh, However, not everybody does it. So if you live in a high tax state, my clients live in high tax states. They know it's coming. You owe X dollars to home. Yeah, they always want more, but that's what you get when you're a multi-state professional. Taxes are different. Uh, I'll went back up to the top here. Do you actually have to submit receipts for each meal? No, that's what per diems do. They are receipt substitutes. And there was a question, can a travel company legally withhold per diems if you don't work all 36 hours? That is an entirely different topic, but there's a legal way to do it and there's a wrong way to do it. And that's been the subject of a number of lawsuits the last 6 years now. Let's
Yeah, we
see.
have another one, Isha. I hope I say your name right. Isha wants to know, some companies have lower hourly rates than others. Should we not take those contracts? I would think the recruiting companies know what they're doing and they are setting the hourly rate low but legal to attract people to take the contract.
In a perfect world, that would be true, but there's 400 agencies out there. Uh, and this is why you want to arm yourself with the information. So, should you not take that contract? Well, if it's a place you really want to be, this is your once in a lifetime opportunity. When I was a traveler, I've still remembered with nostalgia the places that I've been. And don't let that get in the way of taking advantage of a place that you would really like to go. However, if the wage rate is super low, uh, you might want to consider that further before you sign the contract. And you can use us as a resource too. We require contracts of all of our tax clients because I like knowing what's going on out there. Um, let's
All
see. There's a
right.
question here. If
Yes.
you get an apartment where your travel assignment is, but you aren't duplicating expenses because you don't have a permanent tax residence you're maintaining, can you still get tax-free stipends? No, they're supposed to be taxed because the whole point of the stipends is to reimburse you for having a double burden. You're either maintaining two jobs concurrently or you're maintaining two homes.
We have another one from Isha. The OT, the overtime pay, is mixed in the other pay. How can that be separated when filing taxes?
And that's a good question. We actually spent three of our training sessions going over all of the different ones that we saw. 2025, the IRS said, we're not going to require you to put it on the W 2. And they gave a number of safe harbors that you can use with the pay stubs. The thing you've got to be able to distinguish, and again, it's sometimes hard. I have scoured a lot of pay stubs, and it's only February 18th. Uh, is that some of those overtime lines are not quoting the premium, they are quoting the overtime plus the premium. And if you look at the year to date totals and divide it by the hours, you can get an idea of whether that's the total or it's just the premium. And if it's the total, you can just divide that by three. But there are other payroll, that's a whole new world of business. There are so many different versions of payroll out there, so many different companies that provide that. And they're having to tool and readjust. Even we had to do that because sometimes we'll give a different rate from with some of my staff when we get a big load of returns coming in. Being able to isolate that time and a half premium, keep your pay stub in your tax records in case it's ever called into question. But like the California, no, you can't deduct the stuff after 8 hours, but you can deduct the premiums after 40. And sometimes OT pay is really your shift differential. I've seen that as well. So be familiar with how they, put this out on paper. But again, yeah, it's a challenge that a lot of tax professionals. That's probably the biggest. I'm on a number of tax professional boards, and I would say every fourth question: can you look at this overtime and see what's right and what's wrong? Uh, so yeah, good question, observation. Next year you won't have the problem. It'll be on the W two.
All right, we're moving on. Jatame is asking or saying, I am finding conflicting or lacking information when compared to Anderson tax. For example, I understand that OT is a credit and capped at $12,500. Car interest is a certain list of US vehicles with 250K as the income cap.
Okay. First thing, it's not a credit, it's a deduction. And the difference is when you deduct something, it is taken off of your taxable income before you calculate the tax. A credit is when you have calculated the tax and you have a dollar for dollar offset. So the overtime is a deduction. Yes, capped at that for a single. If you're filing jointly, then that's doubled up. Uh, the income limitation for overtime is 150 for the singles, 300 for the joint. Car interest does not come with that cap. It comes with a lower cap. And one of the last ones that I did recently was 100,000 and 200,000. And also it's a certain list. You're right, and the ones that qualify have to have their final assembly in the US. You may look at the VIN number and it says it was made in Canada or Mexico. However, the final assembly might be in the US. And if you buy the car, the dealer should be able to show you that. And there are a number of VIN lookups on websites that will give you that kind of detail. Uh, but yeah, that's a good question because there's different income limitations, and you cannot file separately. That's another one of those limitations that was thrown in there too. So if you have a spouse and you're filing separately, then you generally can't take advantage of those. And for those that have spouses with income-based student loan repayments, that can be a challenge. Uh, Here's one. Where do you find the information that says you got to be wait 7 months? Go to my blog. There's a link that says references and citations. I have had that up for 20 years or so because I get tired of arguing with people on Facebook and I say, just go look at it. It's right there. I don't have to tell you. Let's see.
Yeah, Dan Durazo wants to know if I spend 3 months, like January to March, on Oahu, Hawaii, and 8 months on Kauai. Oh my God, I'm so sorry. Would I need a break before going back to Oahu? I'm currently on assignment back on Oahu since January 26th and thinking of extending to the end of May.
Yeah, you can't commute from one island to the next unless you fly or get a boat. So you can pretty much consider that, even if it's less than 50 miles, you just can't do that. So those are different areas. So you did 3 months in Oahu, went to Kauai for 8. Yeah, you can come back 3 months to Oahu. Now, like I said, the rule 12 out of 24, which is my rule to bridge the 1 year rule and the 3 year rule that's in the tax rules. That's what you want to watch for. And the other thing is don't go back to Oahu 3 years in a row. Those are your limitations 12 out of 24, or don't go back 3 straight years in a row, even if it's just one assignment. So, based on what you're presenting here, yeah, you can do that because those are two separate geographical areas, even though you can probably see one from the shore of the other, maybe. Good
All
question.
right, another question. Could you explain more about the effect of starting a Roth IRA? Got tongue
Oh,
twister today.
okay. There are two types of basic types of retirement. One is called traditional, the other one is a Roth. The big difference is the traditional ones come with a tax deduction. So when you give to the TNAA Total Med 401k, you generally have that reduced from your taxable income. When you pull out of it, it's taxable, even if it's 40 years later. A Roth, you don't get a tax break for. And when you pull out of it in retirement, you won't pay any tax. So you can also have a 401k Roth, and that gets really confusing when you hear that same number. But look for the Roth label. If it's 403b 401k Roth, it is a after tax retirement where whatever you put in, you allow it to grow, you pull it out, it's tax free. Now, if you do that before retirement with a Roth, you can only pull out your contributions tax free, or you get penalized when you start pulling out of your earnings, unless you have an exception like paying for school or first time home ownership. Now, which should you do? Most travelers, because a lot of your income is caught up in stipends and per diems, you really don't have as high of a taxable income. than you do if you're staff. Roths, I'm not an investment advisor, but I've been in this long enough. Most investment advisors will say go the Roth route. And if you've got traditional IRAs and you have a low income year, you may want to consider converting them that year. Uh, and if you're going back to school for a graduate degree and not going to be working, you have an ideal situation to move money from a taxable retirement to a Roth. Uh, Give me a call. We can talk about it.
All right. Dan just had a follow-up question, more like the guy being on Hawaii. To clarify, I can spend another 8 months here on Oahu. Just probably wants clarification.
Yeah, as long as you don't go over 12 out of previous 24 months, then 8 plus 3 is 11. We're fine.
All right, we're moving on with Marcy. Can we deduct any expenses to get to an assignment?
Well, I mentioned that earlier since 2018, and I assume we're talking about travel expenses. Uh, you can't deduct employment expenses on your federal return. There's only 6 states that allow that at the state level. Uh, so generally, there are no deductions in the job expense area available. Uh, we got a question. Can you clarify how far do you need to be in order to collect a stipend tax free? The state is irrelevant. It's where you are. So if you go from San Francisco to Los Angeles, that's a completely different area. You got to be far enough away. It requires you to get rest or sleep, and you have a lodging expense. It's not the mileage or the time. Ultimately, in tax law, it's do you have a reimbursable expense that can anchor to your per diem. Uh, there's a question, what if I stay with family as my tax home? That's fine, but you have to treat them like landlords that are profit driven. So either pay them rent based on the area or take all their expenses each month, cut it, divide it by the number of rooms or number of people, something objective, not just what mom and dad want you to pay.
Also, Charlene is asking, what is the best way to file if you're married so enough taxes are taken out and my spouse is not traveling?
I assume you mean the filing status. Uh, that really should not influence that. I mean, if you're going to a tax preparer, it doesn't take a lot of clicks to compare joint to separate. And 95% of the time, joint's better. So just because you're traveling and having all the extra baggage of the states, that shouldn't preclude you because even those states are going to give you a better rate filing joint. Um, let's see, there's one.
Yes.
Can you explain to 1 year at the same place in the 30-day break? 30 days break is generally what some agencies are going to tell you to do to reset the 1 year clock. And that's not correct. You got to be gone long enough to break that or reset the clock, which, if you look at the references and citations on my blog, 7 months is suggested, 12 months is actually suggested more. Now, you have some other situations where you may go away 3 months and only come back one assignment. I don't get heartburn over that, but that is highly specific to the individual.
Nicole also is asking, can I request that the agency moves more funds from my stipends to my base salary since I will not be duplicating expenses, which results in my stipends being taxed? Question mark.
When you complete your tax residence question, and it shows that you do not have a valid tax home, they are supposed to honor that. So what they will normally do is you will see your taxable wage and then on the line on the pay stub, and then you will also see the taxable reimbursements. They're not going to always combine them. That's really not good to combine them from the agency's perspective because they could be accused of wage recharacterization for doing that. They have to keep them separate, even though it's both taxable wages. So make sure your tax home statement is clear, even if you have to take a Sharpie. I mean, you're doing it by paper and write no tax home on it. If you're doing it electronically, make sure that's clear that you don't have a qualifying tax home.
We received another good question from Douglas, and I'm pretty sure a lot of people were wondering. Is there a specific company you would recommend for filing traveler tax, or would you trust H&R Block or TurboTax to file?
Well, to avoid self-promotion, I would say let us do it. Sort of while we're here, right? The chains like H&R Block, okay, they're hit and miss. When I traveled, to give you a story on this, my ex worked with H&R Block whenever we were in an assignment in the winter. And I gave them the and they were required to do their return through H&R Block. And I put it together and gave it to them, and their manager said, "You can't do that." Well, she had to go up to the manager of the manager and be like, "Of course you can do that." Generally, block preparers, unless they are career, are only there for 3 months every year. And even if it's not block, most preparers only deal with their state and a few states around them. So if you go to Iowa, prepare, and you got California and Oregon, they might, whoa, what's this? You want to go to somebody who's going to ask the right questions, and asking the right questions about your tax home, uh, legal residence, and all of that. That is paramount because you want somebody to watch your back. Uh, I've been doing this for 30 years almost. I've seen it all. And one of the things I train my staff to do is protect the traveler's license, protect the traveler, and warn them if you see something on the contract. Block and Hewitt are not going to do that. They're just going to do the return. That's just a historical document, and they're done. But they're good people there. Don't get me wrong.
All right, Tracy is asking, what did you mean by you cannot go back to the same place more than 3 years in a row? What if you only do 3 or 6 months per year at a place?
3 or 6 months in the same place.
Mm-hmm.
That's your tax home at some point. And I'll give you another example. I have clients that don't maintain a home. They're RVers, but they always go to a snowbird assignment in the Phoenix area. They don't get any stipends because they go back there every year in a significant income. That is a tax home without having to use the exception because it's their regular place of work. So by the same token, if you go back to the same place every year, you have created a pattern of a main place of work. That becomes your tax residence. It's when you don't have a main place of work that you can then allow your tax home to be where you maintain your dwelling at your permanent residence. So either you're making income in the same area regularly or you're not. If you are, that's your tax home. If you're not, then if you have the duplicated expenses set up, your tax home is where you maintain your residence, your permanent residence.
All right, Misty, as a question, I know you touched on it, but I know we have some people join late, and Yeah, had to leave early. Can mileage be written off?
What was that, Isabel?
Misty is asking, can you write mileage off? Can you write it off, mileage?
That goes back to the same thing. It's a job expense. So no. However, if you get travel pay, that mileage offsets the travel pay. So your travel pay is to reimburse you for that mileage. Uh, there's one Laura wrote, why can we keep the extra meal stipends but not the extra housing? No, you can keep the extra for both. As long as you have an expense, you can keep the meal in excess of the meals and the lodging in excess of the lodging. This is why you find the cheaper place and eat ramen noodles every day.
Cassandra wants to know, is there a minimum amount of expenses needed to maintain a tax home? And what is needed to prove that expenses are duplicated in the home state?
In order for it to rise to the level of a tax residence, your expense either has to be fair market or what's reasonable. So often this question is associated when I'm renting from my parents or my brother or sister. You got to treat them like landlords, not relatives. So either go by the rent for the area or go by a split of of the expenses, shared expenses, just like you would do if you're single and you have a roommate and you share an apartment. Uh, if all you do is throw $100 a month and that's a pretty ritzy area, that's not going to fly. Uh, question, Veronica: do you do travel taxes? Yeah. uh,
Layla is also asking, if I travel or if I work in 3 states in 2026 and have a mortgage in New York, for instance, next February or so, do I get my taxes done in New York, or do I have to go all over and do it 4 times?
I know you just have one person do all of them. Uh, that's how I hear the question. You don't have to go to a New York person to have New York taxes done. I mean, like we file in all states, possessions, and in Canada, and I don't have to go to those states, and neither do you. Uh, let's
And
see. Let's see. Please
yeah,
explain
Joseph,
why, if you
Joseph, real quick,
stay at a
Laura.
hotel. Go
Yeah,
ahead.
yeah, because Laura had a follow-up question. Please explain why, when you said only staying at a hotel for 3 nights per week should get 7 days of housing stipends. How is that any different than I didn't pay for meal every day?
If you get a meal, a per diem is generally 7 days a week. Now, there's some gimmicks out there that tell you it's only for the days you work, and then they multiply the per diem by 2.33 if you work 3 days a week. It's really seven. So normally your stipends are 7 days a week. So if you stay in a hotel, you only have 3 or 4 days a week of expense. So for those days you don't have an expense, that's an unqualified per diem or stipend. So that day's per diem stipend is taxable. Meals, even if you go on a fast, you, you don't really, if you're away from home, it's assumed you're going to eat, even if you fast. So for the meals, as long as you're away from home and you have a qualifying tax residence, you don't have to worry about that expense. But if you go home for those 3 days, 4 days a week, now the meal and the lodging is a taxable stipend. Uh,
All right. Linda also has a follow-up question. So if I work in Georgia or Alabama and have a house in Florida, I have to file in those states.
Yep, Georgia and Alabama, Florida doesn't have an income tax. And you're taxable in Alabama and Georgia on the work you did there. You're not exempt because you are from a state without a tax.
All right, Alessia wants to know, what if I take a contract in an area and have intentions of going back to live in that area? How much time would need to pass for me to go back there and live there without having to owe back all those taxes?
Yeah, and when I finished traveling, this is what I my last assignment, I took a permanent job 30 miles away from the hospital I was working at. So most of this is about intention. So let's say you're finishing your contract and you plan on coming back. Well, try to make sure your paperwork is as delayed as possible. Don't start your 3-month contract and sign on to stay permanently. Do it a little later. Uh, and have as much separation from your travel period from your permanent period. So, like in the middle of the contract, you decide, yeah, I'm just going to stay here. I'm not going to get heartburn about that because that happens frequently. I mean, that's the whole point. Some facilities, they want you to do that. But don't premeditate it to where you can see it. The audits, I do audit representation, and I usually cringed when I saw that they had their house on the market and had been almost 12 months in the same area because I know the auditor would go back and check the housing sales for that area. And they do. They have a lot of intelligence available to them. But try as much as you can to get separation between travel time and permanent time so that it doesn't look like it's premeditated.
And Mildred has the question, how often do you have to work or be in your permanent home? I know you touched on that roughly, but maybe you can repeat that one more time. How often do you have to work or be in your permanent home?
You don't really, as long as all the other tax residents parts are taken care of, you don't have to work at home. Can you work at home? Yeah. Now, this is a little piece of trivia, but before 1992, I traveled at 90 to 94. Before 1992, there was no 1 year rule. It was you can't travel more than 2 years, regardless of where you go. Well, that changed in 1992, but we had last decade, towards the end, a number of agencies put a 2 year cap on travel. And one of the reasons they did that was because they were still looking, whoever was constructing the policy was looking back at the old way back in the 1990s. And I know some of you go, oh, I was born in 2000. What do you mean by that? But tax law establishes precedent. So that's the way it used to be. And there were a number of IRS agents that said, well, you've traveled more than 2 years, it's taxable. But that's not the rule now. So I'm just throwing that out in the background because you sometimes you might hear that tossed around because it's part of the old rule. But you don't have to work at home, but you want to make sure that everything else is ironclad when it comes to where's my tax residence? I haven't been in the same place too long. I'm not orbiting, I'm traveling.
All right. Are there specific rules for military spouses working as travel nurses? Interesting question.
What was that? I'm trying to find it on the list.
Yeah, are there specific rules for military spouses working
Oh,
as
yes,
travel nurses?
there are. And on my blog, there is a overview of that. Uh, for the sake of time, one thing to avoid. Usually, the military, the soldier, the enlistee, is assigned for about 3 years. Uh, if some of you know my background, I actually have a seminary degree and I interned at an Andrews Air Force Base church as a intern pastor. And I got used to, my son was in the Army. Generally, you have 3-year assignments. You can't take a travel assignment in the area of the assignment and get tax-free per diems because your spouse is going to be there more than 12 months generally. So that you can't be temporary where the other spouse is permanent unless there's a divorce or separation. That's the most common mistake I see. The second one is in the military, the soldier, the serviceman, servicewoman, their legal home, not their tax home, their legal home stays in the state in which they enlisted unless they affirmatively change that. So if your spouse joined the military and he or she's a Florida resident, they file as a Florida resident. They don't pay taxes to the states that they're assigned in. So a military spouse comes along, and the best thing to do is adopt that home of record of the serviceman, servicewoman, so that when you are working in the area of their duty station, you don't pay state taxes there. That's the Military Spouse Relief Act. But if you're traveling elsewhere or your spouse is being deployed, it brings up some other interesting scenarios, but you want to align your tax home and your activities with your military spouse.
And
Good question.
can you give a rule of thumb on the overtime tax versus non-tax, maybe just for everyone, quick rule of thumb.
A rule on overtime.
Overtime tax versus non-taxed.
Well, overtime is generally not based on the non-tax part. However, that's going into the area of the lawsuits from the last 7 years, where overtime, the lawsuit that has the most precedent basically says if your per diems are withheld or paid by the hour, then your overtime has to be based on the hourly plus the hourly equivalent of the per diem. Now, if that's where the question context is, you're still going to be limited to the time and a half of taxable because you don't have a documentation otherwise. You can't sort of insert a lawsuit that hasn't been repaid later. That's a little convoluted on that area, but I would stick to what your pay stubs clearly say is overtime 1.5. And I may be reading into that question, but I get those questions about the wage suits frequently.
All right, Tracy is asking, do you have to prove that you are duplicating expenses? What if your family member pays all the expenses at the home base?
Do you have to prove if you're duplicating expenses? You always need to be prepared for that. The agency can audit you. If they want to do a random audit to bolster their compliance, they can ask you for proof that you have a payment. So if you're renting from relatives, put something on paper and don't give them cash. You know, check, Venmo, PayPal, whatever you use, transfer to checking so that it's on somebody else's ledgers, not yours or your parents. The bank is that's a third party involved. So don't do cash. And when you're traveling, keep record of your expenses at the assignment location. Because in an audit, they can ask for both. And you want to be able to prove that. And if an agency comes knocking on the door, which some do, you want to be able to prove that as well. And there has been a couple of times in which agencies will actually ask you to show them a lease agreement before they will pay the stipend. And you may think, well, that's too far. Well, there's a whole lot of other industries that have mobile professionals, and it's required. Nuclear industry. I don't mean nuclear techs. I mean nuclear reactors. Every time one is shut down, a rash of people come in, temporary workers to shut it off and bring it back up. And some of the agencies they work for, they have to show that proof.
Yes, we have like 8 minutes left. So if you have any more questions, please put them in the chat while we're moving on with Dimani. Am I better off just finding assignments near my tax home rather than traveling to avoid any possible tax issues?
Well, that's really it depends on what you want to travel for. If you're going for the money, you might as well just work on strikes or the you need to be there yesterday kind of assignments. Uh, if you don't want all the hassle of traveling, and I get that, I did it for 3.5 years. You have to pick up and move or mobilize to each new place. You may not want to do that. Then, yeah, permanent job. But it really, traveling is an opportunity to see the world, get paid for it, and build memories. Um, that was important to me. And I know it's important to a lot of travelers. But if that's not your goal, you may want to compare what you can get at your permanent job or local staff job or any staff job to what you're getting out of the travel contracts and do the comparison. It's really a personal choice.
Yeah, we see this a lot. Our travelers love exploring and getting out there and see hopefully every state. So definitely a perk. Dennis wants to know, should these stipend benefits of the traveler be based on the GSA Gov county or area rate?
Oh, on the GSA site,
Mm-hmm.
it's technically where you sleep, but when you're going to say St. Louis and you get an apartment that's a little ways out, uh, you're generally going to get paid the stipend for where that job is. Uh, Even if where you're actually sleeping is a different rate because it's outside of the city or in another county or whatever.
All right. Jill, my primary residence is in the Bahamas. How does living internationally work for the tax home?
Yes, that's our other specialty is international tax, and I do Canadian cross-border work. And my wife is not from America, and we have to file. She has a rental property in her home country or country she moved here from. We got to file there. You can have a tax home outside of the US as long as you're following the same rules. You have your home that you maintain and you're not repeating the same place. This is what's common with a lot of people may live in Costa Rica or in the Asia and they come to the US back to work. They always have a tendency to take travel jobs in the same location. And if they're not working back in Thailand or the UK or whatever, well, now you've got a situation where you created a tax residence. Yeah, you can do that. One big hurdle you may run into is when you are dealing with the agencies, some of their payroll cannot accept a foreign address, unfortunately. Uh, and that's something that comes up with my Canadian clients. They bring in TN visa Canadians, but they won't put a foreign address up there. So if you have to use a U.S. address, you got to be careful there because you don't want courtesy withholding to create withholding in two states in which one you have nothing to do with when it comes to work. But yeah, the answer to that, yeah, you can have a tax home outside of the U.S.
All right. At what point can I file tax exempt? I am on a strike contract currently. I think that's a very
Never
good
do
question.
that. Never do that. Because, okay, see, what happens with withholding is every time you get a check, it just makes the assumption that that's how you work all the time. So that's why if you get a bonus or you work a lot of overtime, you look at that and go, oh my goodness, look at all the taxes they've taken out. Yeah, by percentage, it's a lot, but you don't work like that all year. So if that happens in cycles to you, yeah, you're going to get a big refund when you file. But when it comes to strikes, you don't know how long that's going to last. And all it takes is one or two pay cycles to kill what otherwise you would have as a refund, and now you're owing. And I think like 5 years ago, there was a big Minnesota strike that drug on for months. And I can't tell you how many clients came to us. They went exempt and they were owing 12,000, 15,000 because they just worked at that strike. So you got to be very careful with it. If you were just dead set on adjusting it, we'll just add a few exemptions. Don't kill it and go straight exempt. Throttle it back, and that's an old. I'm dating myself, right? Just make it slow down. Don't kill it. Going exempt. Don't listen to your friends when they're going, oh, I just go exempt. That's not good advice. You don't want to come up with a big tax bill when it's time to file.
And I think a good follow-up question is, how often or common is it for travel nurses to get audited?
Honestly, it was a lot higher before 2018 when job expenses were killed because the IRS had a bigger window. So what happens more so now is in the 2010s, we had a lot of staffing agency audits. And I fear it's coming back again because it's low hanging fruit because you have so many agencies not doing any tax home compliance or doing it very liberally. And that's a lot of tax revenue there. In healthcare staffing and trucking and construction, we're all in that same universe of workers getting stipends. So the IRS can actually go back 6 years if you underreport your income by 25%. So how often do you see it now? What you see more is the audits of the agencies, evidence gathering by pulling in travelers on a random basis. And you may not even know you were pulled because all they have to do is go and look at what they have on record and then look at the agency tax return if they're looking for some sort of inconsistency there. They may have already done it, but they could, back in almost a decade ago, the IRS sent out a random subpoena notice to 400 travelers just to pull their contracts and have discussions with them about how they were paid. And they can do that again. But when I hear the question, I get a little worried. Well, I'm just going to play the audit lottery. That shouldn't be the reason for your decisions. But yes, it's lower than it was before 2018, but I fear it's going to pick back up because all they got to do is follow the federal ID number of your agency. Voila, they see every W-2 that was ever issued, and they can randomly pick you.
All right, we are at time, 1.5 hours, 90 minutes, talking about taxes. I'm pretty sure everyone's head is exploding and more questions came up. If you have more questions, just send Joe an email, info@traveltax.com. You see it on your screen. He's on social media. He has his blog, everything that he told you. Use him to your advantage. Ask him all the questions. And yes, that was our session for today. Thank you for everyone joining us. And yeah, we'll hope to see you back in one of our next sessions. We already have a lot of other cool things planned. And yeah, this session has been recorded. I know we're sorry about all the technical difficulties. We're trying to work with the audio and make this a little bit cleaner and nicer for you. So maybe check out the recording. It might take us a little bit longer than usual to edit that. But yeah, we'll send it to your email inbox that you signed up with for this session here. And yes, thank you, everyone. I hope you learned a lot. And Joseph, thank you for providing us with all this great information today.
Enjoyed it.
All right, everyone, enjoy the rest of your days. Bye-bye.